Hey everyone, in this video I'm gonna show you a simple trick you can literally start using today to find better entries in your trades. No system is perfect and you're not gonna win every single time. But the whole point here is to show you how you can seriously up your trading game. I'm gonna walk you through everything step by step. I'll show you how it works and what you need to know. Plus, we'll look at real examples. I'll cover the key stuff you gotta understand to make this work. And then I'm gonna show you how you can prove to yourself that this stuff works. So if that sounds good, smash the like button and let's get started. This powerful trading strategy can be applied to virtually any market: forex, stocks, commodities, crypto, you name it. For this demonstration, we'll be focusing on a classic matchup of gold versus the US dollar on a 15-minute time frame. This time frame allows you to capture short-term movements, which can be incredibly valuable for active traders. My goal here is to break this down in a way that's accessible to everyone, regardless of your trading experience. We're not about complex jargon or confusing setups. We're about actionable strategies you can implement right away. So the key component we'll be using today is an indicator called QQE signal. This is a fantastic tool for identifying potential buy and sell signals, giving us clear edge in the market. Let me show you how to add it to your chart. On the most trading platforms, you'll find an indicators tab or button usually located at the top of the interface. Click on that and in the search bar, simply type in QQE signal and hit enter. Then select the indicator from the search results. With one click, it will be added to your chart. Now the QQE signal applied and you'll immediately start to see valuable information being displayed. Okay, so now that we have the QQE signal on our chart, let's talk about what it exactly does. This indicator generates long and short signals based on the underlying qualitative quantitative estimation or QQE. Now the QQE itself is built on the Relative Strength Index or RSI, which many of you are probably familiar with. But here's the key difference. The QQE incorporates a smoothing mechanism. This is crucial because it helps filter out some of the noise and whipsaws you often see with the standard RSI, giving us a cleaner, more reliable signal. It also incorporates something called average true range or ATR to create these dynamic trend lines as stop lines, a fast and a slow one. These lines moves with the price volatility, giving you potential exit points. Pretty neat, right? Now here's the crucial point, and this is something I emphasize in all my videos. As you can see on the chart, the QQ signals by itself generate signals, some which frankly are inaccurate. And this is why I constantly stress the importance of not relying on single indicator. In trading, confirmation is key. We never want to make decisions based on just one piece of information. We need to optimize our indicators and look for confluence, meaning we want to see multiple signals aligned to give us a higher probability trades. We need to filter out false signals. So now we've got QQE signal on the chart. Time to optimize it. Go to the QQE signal settings, usually by clicking a gear icon right to the indicator name. We're going to focus on the inputs tab. Here we'll adjust a couple of key parameters. First, we're going to change the RSI length to 9. This shortens the lookback period, making the indicator more responsive to recent price action. Then we'll adjust the RSI smoothing to 4. This helps us further filter out some of that noise we were talking about. We can leave the QQ factor and threshold options as they are for this strategy. Now, even with those adjustments, we're still going to encounter some false signals and counter trend signals. This is where our next layer of confirmation comes in. We need something to help us determine overall market direction, the prevailing base. So head back to the indicator section just like before. And this time type in market bias and hit enter. Then from the results, select this one and click on it to add it to the chart. The market bias indicator is really a clever tool. It uses a smoothed Heikin-Ashi candles to try and determine the overall trend of the market. The coloring system is designed to quickly show you a strong and weak market conditions. Bright colors generally suggest a strong trend, and while darker colors indicate a weaker or more uncertain environment. Okay, so we've added the market bias indicator, and just like with the QQE signal, we want to optimize it for this specific strategy. Let's dive into the settings. Go to the settings. So in the inputs tab, we're going to keep the time frame, period, and splitting settings as they are by default. No need to change those. The key adjustments we're going to make is the oscillator period. We're going to change that to 6. This will fine-tune the indicator sensitivity to price movement. Next, this is important. We're going to disable the Show HA option. HA stands for Heikin-Ashi. And while those candles can be useful in some situations, for this particular strategy, we want to focus on the core signal generated by the indicator without the Heikin-Ashi display. So simply uncheck that box. That's it for market bias settings. No other changes are needed. Now we have both our QQA signal and our market bias indicator optimized and ready to work together. Now we're getting to the heart of the strategy, identifying the trend. This is absolutely crucial. The market bias indicator gives us a fantastic visual way to do this. It uses color coding to show us prevailing market direction. When the market bias indicator is showing green, it indicates an uptrend, but it goes a step further. It also shows us when the market is experiencing a pullback or consolidation with the uptrend. This is where the color shifts to a dark green. This distinction is incredibly important for this strategy. It tells us when the market is taking a breather before potentially continuing its upward move. Similarly, in a downtrend, the indicator shows red, and when we have our pullback or consolidation within the downtrend, it shifts to dark red. So here's the core rule of this strategy and the way we make money trading. In a downtrend, indicated by red, we're looking for short signals, but we're not just taking any short signal. We're specifically looking for short signals that occurs during those consolidation or pullbacks indicated by the dark red color of the market bias. This confirmation of downtrend and the dark red color gives us a strong confirmation for our short trades. Now, no trading strategy is complete without proper risk management. It's absolutely essential. Always manage your trades. We recommend setting your stop loss at a recent swing high for short trades or recent swing low for long trades, and aiming for take profit at a risk-reward ratio of 1 to 1.5. This means for every dollar you risk, you aim to make $1.5 in profit. Remember, we ignore any buy signals and any sell signals during the light red period. The same principle applies to uptrends. We only take long signals during pullbacks, which are shown by the dark green color of the market bias. And of course, we ignore any short signals during an uptrend.